Self-reflection is a useful tool, I would say, almost in any kind of life situation, particularly in business and particularly in the hedge fund business. The hedge fund business is an ideas-only business. It's a you eat what you catch type of business. So your ideas, your creativity, your ability to deal with uncertainty, almost everything you do is mental. And therefore, I think self-reflection is absolutely key. This is the Not Even Wrong podcast. It's July 21st, 2020. This is Krim Delco. Today, the fund is down 11%. The market is up about 80 basis points. So we are now for the year up 138%, and the market is up about 0.5%. So we're outperforming by, let's say, 137%. Today's driver was not just Tesla, but almost all of our stocks were down except RTX. And the main reason I think today is a reversal from yesterday. We had a large boost in risk assets, in real organic growth assets. And I think today's reversal is, it's just the way I think the markets will work in the future. There will be some up and down on that front, and we don't think that it's necessarily concerning, although we don't like to be down 11% on a given day, of course, but this is the kind of volatility we have to live with. And this is a good segue, I think, into the topic of today, which is what are we and what are we not? Sometimes defining who you are is actually the best way to do that would be to be clear what you're not. And I want to try to do that in this episode. The purpose of Orange Capital Partners is to generate wealth by investing in disruptive technologies with large impact. That's the purpose. The methods that we use are very unique, and we're very conscious about that it's not just a choice that we have, it is the only way. What do we mean by that? For example, the investment industry on Wall Street has certain things that everybody does. And almost all of those things we don't do. For example, diversification is very common on Wall Street. We don't do that. Having a fully invested portfolio, or even worse, raising money and then investing all that money is what most fund managers do. We do it the other way around. We start with the investment and then raise money and then build our portfolio according to investments. If we have more investments, we raise more money. If we have less investments, we raise less money. So the idea is not that we raise money and then find ideas. The idea is the reverse. We find the ideas and then raise money to fund them. Volatility is a big topic in Wall Street circles. There are many ways to supposedly mitigate volatility. We absolutely don't care about volatility. That has two reasons. First of all, we don't believe that volatility is something you can control, because investing is like being part of nature, and generating wealth is participating in natural phenomena. We call these phenomena businesses, disruption, but they're natural phenomena, and they follow the laws of nature and the laws of physics, and there is volatility involved. The same way the weather is not always the same, the same way the snow when you ski is not always the same, or the waves when you surf. The same way businesses, even though you have a good sense for who they are and what they do, even when they're mature, volatility of a business, and most specifically of a stock, is inevitable. And we are not spending energy in trying to mitigate that. Which leads us to the next point, trading. We trade very little. Most hedge funds are proud and also consciously trade a lot. Partly because they want to generate commissions to Wall Street, partly because I think they have the illusion of control, and partly also because they think they can actually control volatility. For example, they set limits, upside, downside. If I make this much, I sell. If I lose this much, I sell. Stop loss. I don't know. There's a lot of things that hedge funds do that we don't do. So we don't diversify. We don't have the aim to be fully invested with a given amount of capital. We reverse it. We find ideas and then fund them, and therefore either grow or not grow, depending on the ideas we find. We are not mitigating volatility, and we trade very little. What's left is, like I said in one of my earlier episodes, the degrees of freedom that we control, in the end, are pretty much only the choice of what we invest in. It all starts with the investment or the idea. Once you have an idea and you build upon it, you start raising funds. To some extent, you raise funds by investing in the idea and growing with the idea. That's raising funds too. Our fund has grown 140% this year, and we haven't raised outside money. We've grown the fund, and that's quite substantial, actually. We also are very conscious about the idea driving the funding and not the reverse. We have very little patience for Wall Street and the constant push to be active. In fact, it is almost the opposite. The less you act and the more you think, the more money you make, which is partly related to, like I said, if you start with the idea, then you don't have to act all the time, because the idea is the action. You don't have to trade around the idea or be busy with meetings. An idea is, if you believe that, for example, take an idea that we are not invested in, but that I think is a good example. Square is a great idea. It's a company that is disrupting the financial industry from the ground up. And once you build that idea, you can follow what they call the innovation stack. You can follow the innovation stack of Square, which means, in plain English, they built the company around problems. And one problem led to the next problem and the next problem, and that's how they build what they call the innovation stack. You can analyze that and use your own judgment to see or get a feel for how successful that company could be. And you don't have to have meetings even with the company. Occasionally you should, but it's not something where you constantly have to be engaged. It's much more something where you have to read a lot, you have to educate yourself. For example, you have to understand the credit card business, the financial business. You have to have a sense for how small merchants operate. So visiting a farmer's market is probably a much better use of your time than going to a financial services conference organized by a Wall Street bank. What I'm saying is that Wall Street has this tendency to be always active, and to some extent that's just the nature of Wall Street, but it's also things like trying to be busy, justify your fees, all these kinds of things that a self-driven, purpose-driven hedge fund just doesn't have to waste time with. The concept of volatility is something that is discussed in financial markets a lot, and there's some interesting studies on volatility. For example, volatility is not a Markovian process, so it doesn't follow asset pricing models where the future price is only dependent by the current price and doesn't have some sort of drift. Volatility is kind of clustered. So once volatility goes up, it stays up for a while and then abates. And then when it abates, it kind of stays abated for a while. So it has these patterns. The point that I want to make more importantly for us is that we are not in the business of trying to mitigate volatility. That's something we are absolutely okay living with. And it's because that's what nature is. Nature is investing is taking part of nature, of evolution. In fact, we are part of the evolutionary process. It's like develop, animals growing out of the ocean, going on land, developing limbs, all of these things. Business is just another form of evolution, and we are part of that, and volatility is part of that. Now, businesses have their own volatility. Our largest position, Tesla, is driven by many vectors, and therefore there is uncertainty. Things go wrong, things can change, things can go well, so it can be up and down a lot. More importantly, the stock market itself, so the stock of Tesla is much more volatile than the business, like many other stocks, are much more volatile than the underlying businesses because they are driven by the wisdom of the crowd, and the wisdom of the crowd is confused sometimes, and the Mr. Market doesn't know, and it's fine. You know, the Mr. Market looks for, should I price it here or there? And then there's algo traders that have their issues, and then there's the index funds, and then there's the inclusion in the S&P. We have earnings. Tomorrow we have earnings with Tesla, and it's probably going to be volatile. Maybe not. Maybe the stock will be flat, but certainly there's lots of expectations and tension around that, and that will be released through the earnings call. As a fund, we have to be comfortable with volatility, and I think that's part of, if not the main value added of a fund manager, is to take the money from rich people and deal with that volatility on their behalf. That's really what we do. Everybody can buy Tesla stock. Yes, of course. Everybody can open a Schwab account and buy the stock. But who can put a large amount of their assets into a company and deal with the ups and downs? Have enough conviction, have enough knowledge, have enough mental capacity to deal with the uncertainty that a large position like Tesla brings with it? Very few people. Same applies for shareholders of Amazon, Shopify, Netflix, you name it. All these disruptors have one thing in common. They're very volatile because they have to be. It's not clear what they're going to be in the future. They don't know themselves. They are in uncharted waters. They are the Columbus of these days, meaning they are going somewhere. They might have a sense for where they're going. They don't know how long the trip will be. They don't know exactly where they're going to end up. Those are very uncertain things. And we have to be very, very conscious about that as in hedge fund managers. But conscious in a spiritual way. That means we have to be conscious about it and also be detached from it. If we let the volatility take us over, then we're just a leaf in the wind. And we can't be like that. So trading is something we don't do. We don't trade for the sake of trading or mitigating volatility because we can't. If we could, we would, but we can't. Plus the commissions and the tax implications, it's just not worth it. Now, last word about raising money. I've spoken about this before, the degrees of freedom. One of them is raising money. We don't believe that that is part of our degrees of freedom. We cannot decide how much money we raise because for us, it starts with the idea. The more ideas we have and the more we can fund those ideas, the more money we can raise. What I mean with that is that it always starts with the idea, with the actual opportunity, and that opportunity has a certain size. Now, those sizes can be big. You can invest hundreds of millions of dollars in Tesla, so it's not very limited, but we are not the kind of fund that starts with an amount X and then spreads that amount over, let's say, 30 positions or 50 positions. And also, we're not very concentrated. Why? Because concentration adds risk. It's exactly counterintuitive. Everybody tells you, oh, diversification, you can reduce risk. It's not true. Because what does diversification mean? You have more positions, that means you have more unknowns. You have more work to do to understand what's going on. You have much, much more probability to be wrong. You have to have more analysts. You have to have longer meetings with more useless communication about things that are not relevant. It's much more difficult to find the actual driving forces of investments if you have too many positions. So diversification is not just like some say you diversify into ignorance and stuff like that. That's one thing, you can argue that, but there is an actual real reason not to diversify, and that is it adds risk to the fund. Don't do that. Stay focused. Be very clear about your ideas. Be good at them, and then raise money according to ideas. You will grow according to how good you are managing those ideas, finding the right ones, and then managing them properly. Raising money is not a degree of freedom. Investing in good ideas, that's your degree of freedom, and I think that's what we focus on, and that's what, in our opinion, hedge funds should be focused on. Thank you.